Reserve will issue its latest interest rate decision. For more on what's expected and what this means for consumers, we're joined by consumer investigator Christine Lazar. And Christine, tell us what's going on here.
Well, so far we haven't seen any rate reductions in 2026.
Yeah.
We're not likely to see one anytime soon. The labor market has softened. Inflation's still above the 2% target rate for the Fed. So markets are predicting a near zero chance that the Fed will lower the interest rate. In fact, experts are predicting that the big bank will consider a rate cut until at least September. For more on how this will impact you, I'm joined by financial advisor Winnie Sun. Winnie, thanks so much for joining us this morning.
Thanks so much, Christine, for having me.
So can you explain why the Fed is likely going to just hold that interest rate steady?
Well, Christine, there's a lot of reasons. I mean, one of the big things, of course, if you've been to the having to fill up your tank, you know, the price of oil is definitely high. And of course, the war that's happening in Iran right now is not helping things. And aside from that, there's also been the continuous of inflation. Inflation is still much higher than the Fed would like.
And so can you explain how the war in Iran has a direct effect on the Fed's decision?
Absolutely. You know, because we know that in comparison to when Russia first invaded Ukraine, well, that was another place where oil definitely spiked. And that really has impact on everything, right? It costs more money to move things around, to ship things, to get our deliveries, to get food moved. And so that impacts then the consumer themselves. Now, all of a sudden, inflation prices not only on our groceries but also impacting things like construction and other areas, especially since this is sort of adding to it and not taking away.
We're also seeing Treasury yields moving lower. Can you explain how the bond markets also influence those interest rates?
Yes, absolutely. So with the bond market, I mean, it kind of makes sense when the Treasury market definitely does impact the inflation rate. So we were looking for, although right now the bond market overall is steady, especially if you're looking for short-term bonds and shorter-term duration securities in that section. But as you go longer, now there's sort of an unknown of where interest rates will be in the future. Overall, our expectation is that we're closer to a rate cut versus then a rate increase. And that's been sort of priced in, and that's what we're looking at. So right now, the Fed is being very clear about, right now, it's not about changing policy. It's about really staying steady and to be more patient.
So at the end of the day, if we don't have a rate cut anytime soon, the rates just hold steady, how does that impact consumers, not just for getting loans, but also the real estate market?
So it will impact consumers, especially for those of you who may have credit card debt and you're paying interest on that debt, or you're looking to refinance your home mortgage, or looking to purchase a new property. Unfortunately, the mortgage rates aren't going to be coming down that quickly anytime soon. In addition, credit card debt as well. That being said, there are things that you can do, but if you're looking for that, we're probably looking at hopefully a rate cut before the end of the year, but it could even take longer than that.
All right, Winnie, thank you so much for joining us and giving us that perspective.